Please see first the previous episodes relating to the accounting for merchandise entities before going through this episode. Their links are on the description below. And if you are done, then let's start. In the last two episodes before this, we have computed the merchandise inventory end. So again, what will happen if we got it? Of course, we can already compute the cost of sales. So let's get back again with the case number 2 as our example. And let's try to compute the cost of sales using the merchandise inventory computed under FIFO periodic, LIFO periodic, and weighted average periodic. As to why am I not yet including the FIFO perpetual, LIFO perpetual, and moving average, it is because I would like to emphasize something later. So how to compute the cost of sales? That will be next after this short intro. To compute for the cost of sales, first we need to get the merchandise inventory beginning, which is in this case 1,000 units at 4.5, which is 4,500. And then we need to get the net purchases, which is gross purchases, less purchase returns and purchase discounts, plus freight in. So in here we have 3 dates of purchases. The first one is on 3/31. However, there are purchase returns related to this that happened on 5/1. The second and the third purchases are from 7/1 and 12/15. So we need to get the result for this, and then we can already get the total goods available for sale of 84,990. Now, we have here the amount of ending inventory that we have computed using the FIFO periodic, which is worth 45,240. So if we deduct this from 84,990, then we're gonna get a cost of sales of 39,750. Actually, in this case too, as long as we have an ending inventory figure, aside from getting the cost of sales, we can also get the gross profit. But first, we need to get the net sales. And based on this case, we have 10,000 units were sold at 10 per unit. So meaning the gross sales is 100,000. But the customers returned 1,500 units last November 1. So we need to deduct 15,000 units times 10 for this, and we will get a net sales of 85,000. And here 85,000 minus the cost of sales, we're gonna get a gross profit of 45,250. So that's it. But we have also merchandise inventory end computed using LIFO and weighted average here. So if we use the LIFO periodics inventory, we will get a cost of sales of 39,600 and a gross profit of 45,400. On the other hand, if we deduct the merchandise inventory end computed using the weighted average, which is 45,299, we're gonna get a cost of sales and gross profit of 39,691 and 45,309 respectively. Now, before we go to the next lesson, I would like to emphasize that periodic inventory system is very dependent on establishing first the inventory end in order to compute the cost of sales and the gross profit, just like here. So again, the inventory end is extracted by doing the inventory count in the warehouse plus of course other inventories which will not be counted in the warehouse, minus of course the inventories consigned only by the other companies. And by the way, the merchandise inventories computed under the perpetual methods were not included in this slide because unlike the periodic inventory system, the perpetual inventory system does not rely on getting first the inventory ending in order to get the cost of sales and gross profit. And actually, in the perpetual inventory system also, each movement of inventory, or in simple terms, each increase or decrease of the merchandise inventory is tracked and recorded. So what does this mean? You will understand that in a little while. Again, the perpetual inventory method do not rely on the inventory count to establish or get the merchandise ending inventory balance, the cost of sales, and the gross profit. Why? For that, let's examine the entries under the periodic inventory system versus the perpetual inventory system. So let's start with the periodic system's purchase related transactions. So we have entries for purchases, purchases returns and allowances, purchase discounts, and freight in here. I know that you're already familiar with these entries because it has already been discussed on the second episode of this series, if I'm not mistaken. Anyway, under the perpetual inventory method, the entries for these transactions are: first, in the purchases transaction, instead of debiting purchases under the perpetual inventory system, the account to be debited is the account merchandise inventory. Now, in the purchase returns, instead of crediting the purchase returns and allowances, the ones credited here in the perpetual inventory system is again the merchandise inventory account. Because it's actually true that if you return goods to the supplier, your merchandise inventory, which is an asset account, will really be decreased or credited. Next is, when recording the purchase discounts, instead of using again the purchase discounts account, we're gonna use the merchandise inventory account again. And last but not the least, when recording for freight in, the perpetual do not use the freight in account also. It uses the merchandise inventory account again. So if you are going to summarize what's really happening right here, we can say that instead of using the purchases, purchase returns and allowances, purchases discounts, and the freight in, you are going to use the merchandise inventory account instead. How about sales related transactions? So in the periodic inventory system, we have already studied for the entries. So we have here the entries for the sales returns and allowances, and the sales discounts. Now let's compare these entries with the perpetual inventory system's entries. So we have here, if we're talking about perpetual inventory system, the entry for the sales transaction is basically the same. However, there is an additional entry which is credit the merchandise inventory account, because when you sell, your inventories will be decreased, right? But how about the debit? The debit is the cost of sales to reflect the cost of the goods that you have sold to your customers. Next is, let's talk about the sales returns. So the same with the sales, the periodic and the perpetual inventory system have the same entry. However, in the perpetual system, there is another entry, which is debit the merchandise inventory account to reflect the goods received as returns from the customers, and credit, of course, the cost of sales. Lastly, we have the sales discounts. So, do periodic and perpetual system have the same journal entry? The answer is yes. And unlike the sales and the sales returns right here, there are no secondary or additional entries here in the sales discounts. They are exactly the same. Why, you ask? It is because when you grant discounts to your customers, you are actually not receiving or letting go of any inventories, unlike the sales and the sales returns. That is why there are no debits or credits of inventories or cost of sales right here. So that's it. Now, let's summarize again the differences between the periodic versus the perpetual inventory system. So, under the perpetual inventory system, instead of using the purchases returns and allowances, purchase discounts, and freight in, you should use the account merchandise inventory account. And in the perpetual inventory system also, it has the same entries with periodic inventory system here. However, there is sales and sales returns issue because in the perpetual inventory system, there is a secondary entry which is credit merchandise inventory and debit cost of sales when we are talking about sales. And lastly, in the sales returns, there is a secondary entry for this, which is debit merchandise inventory, because again in sales returns, you will receive goods from the customers and of course credit cost of sales. How about the other transactions which are not mentioned right here? Are they the same? Yes, of course. So that's it for this particular slide. But before we end this video, in relation to what you have learned here, I'll tell you again. The companies following the perpetual inventory system don't need inventory count to establish their merchandise inventory end. Why? It is because if there are increases in the inventory, like for example in the case of the purchases as well as the sales returns from the customers, the merchandise inventory account is automatically increased or debited. The account is also updated automatically when there are decreases in inventories, like for example in the sales here and of course in the purchase returns. Now, the inventory count is not also necessary to compute the cost of sales because each time there is a sale or a sales returns, the cost of sales is automatically updated. So that's it. The question is, do companies following the perpetual inventory system of recording still do inventory count? Yes, but only to check if the merchandise inventory per records coincides with the actual physical inventory, in order to record loss of inventory if there are any. So that's it for this particular video. Please click like and subscribe and hit the notification bell to be updated on my next video uploads. On the next episode, we will have the comparison of the accounting cycle for service entities versus the merchandising entities. See you on the next one.